Hey everybody, John G. Stevens here with Barrett Financial Group. We are so pumped for today. Obviously, we've got Peter from Arrival. He's going to be here with us, and the one and only Michael Penny. Looks like he just joined. We're so pumped to have him here. So, Penny, I'm going to turn it over to you and get going because this consumer bridge, I mean, this thing is fire. What this can absolutely do for real estate agents and their business, not only their current, but help them grow, I think is going to be phenomenal. So, Penny, take it away.
Oh, thank you so much. I appreciate the opportunity to connect here. And obviously, we have one of our favorite lenders here, Arrival, Peter here. So there are so many great scenarios that are happening in today's volatile environment on the real estate side that allows us to double up or triple up different loan products to give the buyer the opportunity for home ownership. And many times they're in a situation where they have a tremendous amount of equity in their departing residence, or they need to be super competitive on being able to get in the winner's circle on that next purchase. So we've come up with some really unique strategies where you have your government loans, FHA, conventional, VA. But what happens when the buyer just can't get in the winner's circle because of a contingent offer? We tend to give the opportunity where we're able to bridge over the equity of their departing residence, or write a cash offer on their new purchase. Give them an opportunity to have some time to move their belongings, and then ultimately depart from their previous home and move into their new home seamlessly. All the while reducing those conditions and being not contingent on the sale of their existing home, and being able to be confident walking in with a really solid, positive offer. So without further ado, I wanted to introduce you here to Peter here with Arrival, one of our favorite lenders here at Barrett Financial.
Hey guys, thank you very much. Welcome. Hope that you guys are having a great week so far. I am Peter Zomick. I'm the Vice President of Sales and Business Development with Arrival Home Loans, and we are partnered with Barrett Financial Group, which, if you're not familiar with, is one of the nation's largest and best mortgage brokerages out there. And we have a very special and unique product that's only available through limited lenders across the country, Barrett Financial Group being one of those. And it's a residential consumer bridge loan. Rick, do you want to start sharing the slides? We'll kind of get into our presentation today. All we do are residential consumer bridge loans. That's it. We do one product, and we do it better than anybody else. If you think that you know what a bridge loan is, there are bridge loans, and then there's the Arrival Home Loans bridge loan, which is a bridge loan on steroids with a turbo engine. And that's kind of what we're going to get into and talk about today. But before we get into it, as realtors, let's talk about some of the problems that buyers are facing in the market today. The first is, because of debt to income restrictions, if they have a current home and they have a mortgage on that home, a lot of potential buyers find it very challenging to qualify for another home while they still have a mortgage on their existing home. A lot of folks, especially in this low inventory market, are very nervous about putting their home on the market before they find a new home, because they can find themselves homeless. Well, all right, maybe not homeless, but they're going to have to move to temporary housing, get a short-term lease somewhere, move all their belongings into storage, and start looking for another home. Then they find a home, then they got to either break that short-term lease or ride it out and pay if they find a home before it expires, get all their stuff back out of storage, qualify for the mortgage, move. It's a pain in the butt and very stressful and frustrating. And then some other folks that you probably are very aware of have a home that's quote unquote lived in. They've been there for many, many, many years. And in order for them to maximize the dollar that they can get for the sale of that property, they need to depart. They need to get out of it first. They need to freshen it up, do some minor renovations, maybe professionally stage it. And it's really tough to do when they're in it. So our consumer bridge loan solves for all these problems with one transaction. What we saw come on the market in this low inventory market about a year and a half or so ago answered the number one: can't qualify for multiple mortgages. We saw a lot of these companies pop up on the market that offer these guaranteed backup contracts. And you may be aware that Fannie and Freddie and some of the GSEs say, if you have a buyer for your home that's a non-contingent offer and is closing within 60 or 90 days, then you can remove the PITI mortgage payment from your debt to income ratio. And these companies served a great purpose and worked very well to help these buyers who are selling their home qualify for a new mortgage before they actually sold their departing home. The problem is these guaranteed backup contract companies are not really good for consumer because one, they charge a fee for their service, and two, they offer a 75 cent or less on the dollar valuation for the property. So they're forced to sell the property under value unless they can find another buyer within a very short time frame, which puts a lot of stress and pressure on that person trying to sell their home so they can buy a new home. So did that really solve the problem? Not really. Then we have folks that offer your swing loans, which is your true cash out second mortgage bridge loan or home equity line of credit that has a lot of restrictions that gives folks the ability to get the cash they need for a down payment, but then they need to go and qualify for another mortgage. And that leads us back to the problem one. Do they need a guaranteed backup offer? So our consumer bridge loan is a lot different because with one loan, it unlocks the equity in someone's departing home and completes the purchase of the new home all in one transaction. So let's talk about what this loan is and how you can get this through Barrett Financial Group. This consumer bridge allows someone to buy a new home first. We do this through a process called cross-collateralization. We will cross-collateralize their current home along with the new home with one mortgage note. So it's one mortgage note collateralized on two different properties. It is a short-term solution that requires an exit strategy, and we'll talk about what an exit strategy is in just a few moments. And so what we do is we use the equity in their existing home and the potential equity in the new home for the down payment or full purchase price or more of the new home. 95% of the fundings of our loans are for 100% or more of the new home. Rarely is our bridge solely used for a down payment. So let's talk about our guidelines, because this is where you can really see how different we are from everybody else on the market that offers bridge loans. The first is we are a residential consumer bridge lender, meaning your buyers have to be buying a primary residence or second home. Our term is an 11-month balloon, but although it's an 11-month balloon, on average, our loans pay off in 4.5 months. They're interest-only payments with no prepayment penalty. Some folks pay off our bridge before they even make their first payment. The program allows for a max combined loan-to-value of 75%, but that's 75% of two properties, not 75% of one property. That's where the power of cross-collateralization really comes into play. And in just a few moments, we're going to do an example and show you how you calculate a loan amount. We do require a minimum middle credit score of 680. And we are the only consumer bridge lender that I'm aware of that allows for a loan amount higher than the purchase price. So we will allow more than 100% LTV on a purchase. Sounds crazy that we allow cash back on the funding of a purchase loan. Through Barrett Financial Group, you can help your borrowers obtain a new home before they sell their existing home. So there are three primary reasons why folks want to borrow more than the purchase price. The first one is we do require interest-only payments. There are some other bridge lenders out there that have deferred interest and don't require any payments and tack it onto the back end, and then when they sell the departing home, they can pay it off. We're a little bit different. We do require interest-only payments. Sometimes that could put a financial burden on somebody's family because they have all of their current monthly financial obligations, including the mortgage they may have on their existing home. And now they're going to have another interest-only mortgage, which is the bridge, which can cause some financial hardship. So if the equity allows, we'll allow folks to get cash back in the funding of the purchase so that they can take that money, put it into their own bank account, and use that money that's theirs. It's just equity unlocked that they put into their bank account. And they can use that money to make the interest-only payments on the bridge while they have it and not have to worry about any financial hardship. The second reason we see folks borrowing more than 100% of the purchase price is they want to do some minor renovations. They want to fix up. They want to professionally stage and maximize the sales price of that departing home, but they need the money to do that. We will allow that if they have the equity. And then the third reason that we've actually seen over the last year in this low inventory market is folks are finding really nice homes, but they want to do a little bit of improvements to it, but they need the money to do that. So again, if the equity allows, we'll allow them to borrow more than the purchase price to do those things. So the borrower must have a viable exit plan. The exit strategy is probably one of the paramount underwriting guidelines that we're looking at when we're underwriting and conditioning a loan for approval. We're going to talk about the exit strategy in just the next slide. Our loans are reduced alternative documentation loans. For those folks that have been around since 2000 to 2006, before the mortgage meltdown, our products are stated income, stated asset, and no appraisals in most cases. We use internal AVMs for valuations, and if those valuations are acceptable to do the loan amount at the amount the borrower wants, then we don't need any appraisals. If you have a borrower that was working with another lender, and let's say at the last minute the loan falls out, well, if you already have an appraisal, that appraisal can be assigned to us, and we'll use that. If one or both AVMs come in a little bit low, and you as the agent, you're like, oh, the house is definitely worth more than that, well, we can elect to order an appraisal and use that in lieu of the AVMs. We don't have any debt to income restrictions on our loans. We are exempt from the ability to repay due to the short-term nature of our product. But don't let our product scare you, right? I'm saying stated income, stated asset, no appraisal, no debt to income ratios. This is not the Wild West. We have been offering this product for 12 and a half years. We have never foreclosed on a borrower, and we've never lost an investor money. We give good loans to good people that we can afford to make the payments and have a decent exit strategy. And we're going to talk about that exit strategy in just a minute. We are also one of the few bridge lenders that does not require their departing residents to be under contract. In fact, we don't even require the departing residents to be listed at the time of the funding of our bridge. That gives them plenty of time to prepare to see what they want to do with the property. You as the agent can help guide them through some minor improvements to maximize that sales price to create a win-win for everybody. Now, the cross property, most of the time it's their departing residents, but it doesn't need to be. The cross property can be a second home maybe they have an investment property, maybe their current home they're going to convert to investment property, and maybe they have an investment property that they want to sell. Well, the cross property can be that investment property. Having said that, let's talk about the exit strategy. Like I said, it's really, really important. Because there are no debt to income restrictions, the exit strategy is, hey, what's this borrower's plan to pay us off within 11 months? Typically, here's what happens. They close on the bridge, they move into their new home all excited, they either do some minor renovations, professionally stage their current home, maybe their current home's currently on the market, maybe they put it on the market, but then it goes under contract and it sells. When it sells, we will take a portion or all, depending on the borrower's financial situation, proceeds of the sale of that home and pay down our bridge. We'll release the lien on the departing home. That sale will be complete. And now they'll still have a mortgage balance with our loan, which is the bridge, on the new purchase. So what's the strategy to pay us off now that their home is sold, but they still have a balance on a bridge? Very simple. You get back in touch with Barrett Financial Group, and they will do a rate and term refinance with the borrower and get into a longer term mortgage strategy. Maybe it's just a regular conventional loan with the balance that they're going to be at. Maybe it's going to be a jumbo loan. But Barrett Financial Group will do what we call the takeout loan. That is normally what we see, which is number 2 here, the refinance, the purchase property for the remaining balance. Some folks will sell other assets or investments to complete the purchase, and some other folks may be coming into money shortly through an inheritance or something like that. All right, I froze for a minute here. For some reason, my slide is not advancing.
Let's see what we can do here. While we're reviewing that, and while that's unfreezing there, it's really interesting. A lot of individuals, they want to purchase a property, but oftentimes their debt to income ratio is just too high to carry both mortgage, principal, and interest. What the great thing is, and many of you hear the term buy before you sell. This is something that we're talking about, right? But we're going much more in depth, giving buyers the opportunity to purchase without contingencies. give them opportunity to potentially borrow more money to fix up their departing residence to get it in immaculate condition to attract even a higher payout on that departing residence. And we're not restricting on that. So just doing the backup offer, or where we're taking out the debt to income, increasing the debt to income, is going to give your buyer more buying power and get them into that other scenario. There's other scenarios that was mentioned on that previous slide, talking about jumbo and what have you. There are a lot of scenarios that come to us where they're like, hey, our property fell out of escrow, and we need to find a solution to fix this. And what we're able to do is a very quick bridge. We're bridging that equity over, giving the buyer the ability to close on time on their new residence, and then we're working everything on the back line. I know, Peter, we're going to go into scenarios and we're going to go into case studies and things like that. So I'm really excited about moving forward on that. But it looks like we have our slides going here.
Yeah,
Great. I'll continue there.
Sure. You mentioned, something, falling out of escrow and they need a quick solution. Our average funding right now is 16 days. From application to fund is 16 days. And that's taking into consideration TRID, which we do follow TRID. And that's also taking into consideration the departing residence is considered a cash out refinance, but it is a purchase transaction. So without getting too into the weeds, if their departing residence is a primary residence and it's considered a cash out refi, there's also a 3-day right of rescission that we need to kind of account for in the timelines. So typically, if you have a close of escrow on your purchase, say tomorrow, which is Friday, well, then all of the closing documents for this bridge would have had to been on Monday, which was several days ago. We know all that. We'll communicate with that, the timelines. The most important questions that we ask all the time is, when is the buyer expecting the keys, and when does the seller want their money? And when is the loan going on record? We'll back into all the dates from there and handle all the paperwork and all the disclosures. All right, so let's calculate how it works. How do you calculate a loan amount? So in this scenario, I know you guys can read, but let me tell you the backstory. We have an older empty nester couple. They've raised their family in here. Their kids are gone. Their kids have kids of their own, and they've been in this house for a long time. The house is now worth $1 million. They've been paying on this mortgage for quite some time and only owe $200,000 on it. And they're looking to buy into an active adult community at $800,000. We do some mortgage math to figure out what's the maximum loan amount that these folks can borrow or qualify for. At 75%, adding the $1 million plus the 800 gives us 1.8. 75% of that is 1.35. Time out though. We're, again, one of the few bridge lenders that will allow ourselves to sit in second lien position on the departing residence. We are not going to require the borrowers to pay off that low interest first mortgage that they may have. We're going to sit in second lien position, which is very important. So once we account for that $200,000 mortgage balance, number 3 up above here, they qualify for a $1.15 million loan. They're only borrowing, or they're only buying an $800,000 home. So in this example, they can borrow more. Remember, I said they've been in this home for a long time. They've raised their kids there. Surely they're going to do some freshening up, maybe professionally stage it. Maybe these folks are on fixed income, pension, Social Security, who knows? Maybe they need some additional funds to make the interest-only payments, while their home sells. That's where this product really becomes powerful as a solution for folks. So remember, our term is 11 months. Interest only, no prepayment penalty. All right, so here are scenarios on why you should think, about Barrett Financial Group and the bridge loan that they're able to offer through our organization. Your classic buy before you sell. Vacate, rehab, touch-up stage. Being able to make an offer without contingency. According to Redfin, last year, 34% of buyers were cash buyers. And in this market, I don't know very many sellers who are accepting contingent offers. If your buyer wants to be serious, this bridge can be a great way for them to do it. You simply reach out to Barrett Financial Group. Barrett Financial Group will get an application. They'll run a credit report. They'll send it over to us. We'll offer a formal pre-approval, and they can make a non-contingent offer. Very powerful. Folks don't want to double move, right? They don't want to get caught in renting a little bit, selling their home too soon. Not only down payment challenges, but like I said, remember, our loan, one loan, will unlock the equity in the departing home, and complete the purchase of the new home. Some folks are going through divorce or probate, but they want to buy now. And then a bridge loan, instead of liquidating other assets, which may cause capital gains or other tax consequences or penalties. All right, let's talk about a few case studies so you can kind of see where the rubber meets the road.
While we're doing that and reviewing some of these case studies and telling some amazing stories, what would be great is that we did create a form because we all know that every real estate transaction is going to be exactly the same. So what we did is we actually created a link that gives you the opportunity as a realtor or mortgage professional to be able to put in your scenario, give us an understanding of what your situation is looking like for your buyer. We want to be able to support you on that exit, to support your buyer in home ownership, and as well as giving them an opportunity to stay in their property and not be homeless, like we were talking about earlier. And I give them the opportunity to have that leeway to purchase a property, be able to get into a new home, give the opportunity potentially to fix up their existing property, or just be able to do what they need to do. So in the chat there, you'll go ahead and see a link that you'll be able to submit your form of what your scenario might look like. So love to learn more, Peter, on what other case studies we're looking at here.
Great, I appreciate it. Thank you. So in this case study, it was a fast close, move up borrower. They planned to sell their home in the spring. They were dabbling on the internet in the winter, and lo and behold, they found a house they loved, but they weren't ready to sell their existing home. They knew they couldn't make a contingent offer. They had great credit, but they couldn't qualify for more than one mortgage. So they came to us. We gave them a $2 million bridge fairly quickly, a non-contingent offer. They won the home, got into it. A few months later, 4 months, they listed and sold their departing home, paid down on the bridge, and then the loan officer that referred the deal to us helped them get into a longer-term mortgage strategy. So this next one is a borrower with credit issue. Well-qualified borrowers, except a tax lien popped up on their credit report. It didn't pop up on title to the departing residence, but was on their credit report. Borrowers said, hey, this is an error. We're working with the IRS to get this cleared up. The conventional lender said, we can't approve this loan until you get that removed from your credit report. Well, they came to us. And due to the subjectivity allowed in our underwriting process, because we don't follow anybody's guidelines, Fannie, Freddie, Ginnie, GSEs, we have our own guidelines. We asked for all the documentation that the borrower had to kind of convince us with confidence that that tax lien was in fact an error. We evaluated all the documentation. We believed them. We knew that the government was a bureaucratic place and it was going to take time to get that off of the credit report, and they really didn't want to lose that house. So we gave them the bridge and had the confidence that within the 11-month balloon term, they would be able to get their credit repaired, get it removed, and be able to get out of our bridge. And that's exactly what happened in this issue. This next one is really interesting because we are the only bridge lender that I know in the entire country that allows for multi-state cross-collateralization. That means that a borrower may live in one state and buying a home in another state. We're currently licensed in 11 states, and I'll give those states in just a minute. We will be licensed in about 20 states by the end of the year. And so Barrett Financial Group will be able to help you as we continue to expand as well. But these folks lived in California, wanted to retire to Arizona, wanted to buy a new construction in Arizona, and the builder, because of the customization and all the bells and whistles they get to pick out in this home, would not allow them to put a contingent offer in, which I wouldn't either. So they were frustrated because they couldn't sell their home because the home was being built. They couldn't make a contingent offer. The loan officer went to their product guy who said, hey, did you know we're partnered with Arrival? And he came to us. We educated them on the program. He explained it to the borrowers. The borrowers loved it. We pre-approved them. They made a non-contingent offer on the house and lot they wanted. They got it. It was about 7 months later. They got the COE on that home. That's when we actually closed on the bridge and gave them the money. The builders were happy. The buyers were ecstatic. They moved to Arizona. Several months later, on their time, they did what they needed to do to their home in California, but then they sold their home in California and they refinanced into a longer-term mortgage strategy. So that's, kind of how our bridge loans work. You can see folks come into them for kind of different reasons. But the exit strategy we've seen is very similar. Sometimes there's enough equity in the departing home that when that departing home sells, they can pay off the bridge in full. And some do that, and that's okay because remember, there's no prepayment penalties. I'm not going to get too into this right now, but because of the short-term nature of our product, because of the interest rate, because of the points and fees, these are considered high-cost Section 32 loans. Barrett Financial Group will worry about this with your borrowers or your buyers. You don't need to. The only thing to be aware of with our loan, the buyers do need to take a high-cost home loan counseling session. But just know that we have never lost a borrower withdrawing because they had to go through this counseling session. The counseling session in a nutshell is to make sure of two things. One, the borrowers know the type of loan that they're getting. And two, they're going to be able to make their payments and meet their financial obligations while they have this loan. That's it. And so the seller or builder, if you work with builders, can pay the points and fees on this type of loan. But if the borrower is paying the points and fees, they have to have that at least invested into the transaction because you can't finance points and fees on a Section 32 loan. Wait a minute. I thought you said, Peter, they can get cash back in the funding of a purchase. Now you're saying that they actually need to pay the points and fees up front? I'm a little confused. So was I when I first got introduced to this. But here's how it works. We get audited quite often because we have a very unique loan and there's not very many folks that do it. We pass our audits with flying colors. But one of the things that auditors look for is documentation that the borrowers wired the points and fees or more to title and have that invested into the transaction. So the earnest money counts towards the points and fees. And I'm just going to use an example. So let's say, our average loan amount is, I think, 1.2 million last year. It's trending a smidgen lower this year right now. But let's say the points and fees are $25,000, and let's say that your borrower gave $20,000 in earnest money. Well, there's a $5,000 deficit. Sometime at or before closing, those buyers are going to need to wire an additional $5,000 to escrow. Now, when the loan funds, depending on whatever the loan amount is, they can get all that money back and then some. So yes, anything that they send this way can come back this way once the loan funds. It's just documentation for auditing purposes only. So that's really, it in a nutshell. But I know we have a lot of agents on this call today, and this product is a great way to unlock future buyers that are sitting on the sidelines and get them into the market today. There are many buyers that have a home to sell. They're just sitting on the sidelines right now that want to buy a home, but think they need to sell their home first, and they have no motivation to sell their home right now. Let's talk just briefly about some of the reasons why they have no motivation. Well, one, if you have kids or a dog, selling your home while you live in it could be a royal pain in the butt. Trying to keep your home immaculate all the time with kids and pets is tough. Just for that reason alone, some parents are like, we don't want to deal with it. An emotional thing about selling a home is depersonalizing that home, making it more of a house and not a home, putting away all the memories, the pictures, the photographs, the memorabilia of life and the memories you've created, so that when a buyer comes through, they can envision themselves living there, not thinking they're visiting somebody else's house and not feel homey. And then, gosh forbid, you're having family time, helping the kids with homework or cooking dinner. And, an agent's like, hey, I've got a buyer, they are only in town until tomorrow and they want to see your house in 20 minutes. And then you got to pack up and leave. All these reasons, and there are many more why folks don't have the motivation to put their home on the market and sell, but they want to buy a new one. Well, what if you can help a percentage of those folks get off the sidelines, out into the market today with Barrett Financial Group, and help them buy a new home today? That creates a buy-side transaction for you today. Will help your new partner, Barrett Financial Group, fund a loan. Will help a borrower meet a lifelong goal and a dream without the financial stress and anxiety. And then when they move into that new home, guess what? It's going to create a listing opportunity for you to sell their departing home. That creates a second transaction for you, and it will also help Barrett Financial Group and your borrower with another transaction to get out of our bridge in full before the end of the bridge period.
One thing that I mean, in the trenches, right? Day in, day out, doing loan after loan and real estate transaction. It's heartbreaking to watch a buyer come into write an offer and have it overshadowed by a non-contingent offer or cash offer. We want to write an as similar as cash or a non-contingent strategy to give those buyers, like I mentioned earlier, to be in that winner's circle and be able to give them the opportunity to see the light of home ownership there. So, I mean, I can't emphasize enough how empowering it is to be able to come to your clients and give them a strategy to exit and purchase a new home without all the stress. And this is that opportunity. And, you know, this is not like one of those big commission scenarios. It's more or less like we want to do it, be able to do the purchase on that transaction. We're trying to find solutions for you to get that buyer in that winner circle and get that property sold and that buyer to win that buy side.
Great. I was wondering if you guys have any questions, anything I may have missed. The states. Let's talk about the states that we're licensed in real quick. And, you know, if you guys want to pop that in the chat, you can do that. We're currently in Arizona, California, Colorado, DC, Idaho, Michigan, Oregon, Washington, Texas, Georgia, and Utah. We're preparing docs to fund loans in Utah right now. We've just submitted our application a week and a half ago for Florida. We're really excited for Florida. And we have Tennessee, Maryland, and Illinois coming up within the next quarter. And then, you know, third and fourth quarter should bring us to about 20 states.
That's amazing. Absolutely. And this is a brand new opportunity for Utah, right? Is that what you're saying?
Yes.
That's amazing. So something like this has not been done in Utah, and it's a first of its kind. And we love coming here to share with you in regards to the different types of strategies to get your buyers and sellers the opportunities to win. That's what we all like to do, right? Is win-win. So, you know, it's absolutely phenomenal to think of, like, not only are you getting a bridge to purchase your new property, be non-contingent, reduce the debt to income ratios to give those buyers more buying power, but more importantly, give them a better opportunity to shine with that departing residence. Give them the potential opportunity to renovate or just, you know, get a fresh coat of paint on the walls there, you know, to make it move-in ready. That's what buyers really love to see. It's like they want to be able to see themselves in there. So I'm really excited about this. And again, in the chat, you'll see a Google form where you're going to be able to put your name, email, phone number, and also just a brief description of the scenario. I added my name, email, phone number as well. Obviously, we're always working. We're always available to support you. And even if it's just a debt to income ratio scenario, or the buyer's just or you're just falling out of escrow and you need a simple solution, we're here to help you regardless of the scenario. We're just happy to be part of your ecosystem and be a resource that you can leverage to grow your business. So, Peter, any last remarks that you wanted to share?
Yeah, so, you know, I talked about, you know, our unique cross-collateralized solution. And roughly 90% of our fundings are cross-collateralized. But we do have a non-cross-collateralized bridge that you guys should be familiar with as well. So let's say that somebody owns a home free and clear, their departing home. We can still do a 75% cash out refinance on that. And if that gives them enough money, say they're downsizing or something, they can literally pay cash for that new home. So we can do a 75 cash out bridge, again, stated income, stated asset, no appraisal, no debt to income restrictions. And once we fund on that cash out refi, we will take those funds and wire them directly to the escrow company that's handling the purchase, and it will literally be a cash transaction for your buyers. So
that's really
interesting
interesting.
to know.
That's one of the coolest things. Really, like imagine walking into a closing table with cash. Everybody else is financing, or maybe there's a scenario where it won't get qualified, and their buyer pool doesn't, it's just not there. So coming in and being able to win the day and potentially get a lower price for the property without all those contingencies, and come in with cash. You see all these opportunities. Like, how do they do this? How do they come in with cash? It's companies like what Peter's offering here, and what Barrett Financial is offering to you is a unique strategy to get those buyers that in that circle. Not everybody has cash, but they have the opportunity to leverage. So let's find solutions for you and your buyers. And it looks like we do have, like you see up on the screen, who actually funds the loan, Barrett or Rival, or another third party.
So I put in there, Arrival funds a loan. So we are the lender. We underwrite the loan. We fund the loan. We do everything at Arrival. There is no kind of other third party behind the scenes that we're sending the loan out to and waiting. We make the decisions. We have the funds. We use either institutional investors. We have our own private funds that have millions and millions and millions of dollars from accredited investors in there. We use warehouse lines. We have the ability to fund $2 billion annually. So I know with some localized smaller bridge lenders, you get concerned that, the middle of the end of the month is running around and they run out of money and they can't fund any more loans. You don't have to worry about that with Barrett Financial Group and Arrival Home Loans.
Yeah. In most cases, we're all obligated to use the Freddie Fannie guidelines or what have you. But just to give a bit more clarity on why we're partnering together in this scenario. So Barrett Financial Group has partnerships with over 160 different lenders or banks, right? So Arrival is one of those that offers this very unique use case scenario that we can actually accompany with other strategies and so on. So the reason why we're the number 2 mortgage brokerage in the United States is because we partner with the best. We have close relationships with them. We want to be able to provide the documents to help their underwriting team or do correspondent in-house. We want to be able to support everyone in general. So this is very important for us to bring Arrival to the table and give you the opportunity to be even more powerful in your community. So again, Arrival is the lender or the bank, right? Barrett Financial is the broker who's finding Arrival to find for this solution. I made a joke earlier that every transaction is the same, but we all know it's completely different on every single transaction. So we take that approach as a broker to identify the wishes, needs, the scenarios, of that buyer, right? And then we're finding the products that are going to fit the best. We're presenting them in a fashion that's going to give the buyer the opportunity to see what availability is for them, and realistically, because we're a direct broker, we're able to provide very unique strategies, and then also offer extremely competitive, and most likely we won't be beat in most cases on rate. So we want to be able to find a solution for your buyers. We want to give them different scenarios on how that would play out, but we want to be able to be their financial advisor and support them with whether they're going to stay in the property for 5 years, they're going to need to bridge over. Perhaps there's an investment property. Maybe they are an ITIN. Maybe they're a scenario where they need to do a bank statement loan for 1 year. There's just so many different scenarios that we can do. But with that, we have every product known out there. And this is just something very unique that you haven't heard about, and we wanted to bring it to the table. So we'd love to see if there's any other questions that you might have. All right. Well, it seems like regarding your the amount that you can actually, I have a question here, Peter. The amount that you can actually borrow, right? against equity, what is that? What do those percentages look like when you're doing an AVM or a automated evaluation on a property? What numbers are you looking at, and how high can we go in regards to the loan value?
So it's 75% loan to value. Our minimum loan amount is $250,000. Our maximum loan amount before an exception is needed is $3 million. From 3 to 5 million, we need about 4 or 5 days to get an exception, and from 5 to 10 million, we probably need a week to a week and a half. We do fund loans, very high. As we go over 3 million, we're looking for compensating factors just to be aware of, whether it's reducing the LTV from 75 to 70, over 5 million, maybe down to 65, whether it's verifying assets, maybe getting appraisals. But just know we can do those larger loan amounts. Our average loan amount is, like I said, 1.2 million. And we allow folks to borrow 10% over the purchase price without even asking a question. So if someone's buying $1 million home and they want to borrow 1.1 million, as long as the equity allows, we won't even ask why. Once it gets over 10%, we want to start asking why, because these aren't really structured to be rehab loans, and we want to make sure we're getting a good understanding of what they're using the funds for. Rates. Our average interest rate is 10%. So you have to remember, this is a private money, alternative finance type of loan. It's a little bit more expensive. However, remember, they're only paying interest on the months that they have the bridge. Although it's an 11-month bridge, they do pay off on average in 4.5 months. Example of points, points are roughly 2.5 points. And so when you think about the points, and this is a good example, when you're working with a buyer and they're looking for $1 million home and there's offers on it and it's competitive, and I talk to realtors all the time, if a buyer finds a house that they like for $1 million and it's competitive, I ask the agents, would that buyer pay $1,025,000 for that home to win the offer, knowing it's going to appreciate, knowing they love the home, knowing if they wait, they may be paying more later and losing out on appreciation? 9 out of 10 agents that I talked to said, yes, 2.5% over, that's not very uncommon. So our points and fees are equivalent to what a buyer would normally be open to paying over asking. Well, instead of paying over asking for the house, they're just paying it in points and fees for the bridge. So good question, Stephen. Hopefully that answers it for you. I'll turn it back over to Penny.
Sure. Yeah, I mean, obviously, as we mentioned earlier, every scenario is different, and a lot of people just need to be able to leverage the debt to income ratio. They need to leverage equity. They need to bridge some or all over. So we just want to be able to understand the full scope of the scenario. So we do have that Google form where we can actually get some time on the book so we can talk about that unique scenario. It looks like we do have one more question that came through just recently.
Yeah. So no, it is not the standard HUD counseling. They don't have to use the HUD counselors that we recommend. It is specifically called the high cost home loan HUD counseling. And it's specific for the transaction, and they need to provide a copy of the loan estimate. So they can't take the housing course before they have identified a property, before they've made application, and before they've received a loan estimate. So hopefully that answers your question.
These are all very good opportunities to take a look here. Great job, good information. That is fantastic. So really looking forward to the continuous work with you. I think there was one situation that came into Barrett, right? How high was that? How high was that loan? Was it was it 3.4 million?
I think it was 3.4 million.
Yeah. So don't think that you can't bring something large or jumbo, super jumbo to the table. We have had situations where we were able to leave a departing residence, get into a larger home, offer cash, and be able to do that in a jumbo market. So no scenario is off limits. We just want to be able to understand the scenario in full details, have that consultation with your borrowers, see if we might be a good fit. But regardless of anything, we want to be able to support you and finding the right fit. So that's what made us be the #2 mortgage broker in the United States. Be true to the end goal, and that's to the fiduciary responsibility to our clients. So, with that, do you have any other insights? I'm real excited about leveraging this. Please give me a call. My number and my email is in the chat there. But you're welcome to reach out to me. Obviously, Steve and I are on the call multiple times, just trying to work through scenarios. We have multiple AEs that we're working with within this organization to support you. And it's kind of crazy. A lot of people do come to us because they have a scenario where it's kind of falling through, right? The other broker wasn't able to, or the lender wasn't able to perform, and it was something that was oversight, or it might need to require a manual underwrite of all things. I mean, geez, why don't you just roll up your sleeves and get the work done? It just drives me nuts why we're not able to just get it done. That's what it's all about. Just work through it, understand the scenarios, and work through it. I mean, the fastest loan that I was able to close was in San Francisco, and actually it was 8 days. And I think that's like almost, it's like on the cusp of that, right there. So we were able to do it in 8 days. So we were able to get everything done. And it was one of those scenarios where a buyer just was in a dire scenario, and luckily that phone rang to the right team. So we're able to support you borrowers regardless of in escrow or need a second opinion, or need to just have a conversation to give them an opportunity to see the light at the end of the tunnel there. So with that, Peter, I really appreciate the time and effort that you're putting into all of this, as well as the supporting staff on bringing this. There's so many moving parts behind the scenes. So if there's anything that we can do, please reach out, contact us, use that link in the Google form to just let us know that you need some support, and we're happy to help you out. Thank you so much, guys, and I wish everyone a wonderful Thursday afternoon. Thanks so much.
Bye, guys.